What if I told you that there was a way for you to be able to recapture every single dollar that you spend on your property taxes? Hi, I'm Russ, and welcome back to my channel where we are building wealth through opportunities. Today we're going to talk about escrow accounts. Now, escrow accounts are a necessary evil that we all have to contend with, especially if we're homeowners. Usually the way they work is you send off your mortgage payment every single month, and a portion of that goes towards property taxes as well as homeowners insurance. Well, you may not know this, but you can call up your mortgage company in most cases and request that you handle those payments moving forward. You just need to check with your mortgage company and make sure that you can do that on your own. But what I'd like to demonstrate for you today is how you can pay those payments yourself and recapture every single dollar that you've paid. And I'm going to share my screen right now to demonstrate. Usually the way this works is we send off a payment every single month to the mortgage company, and at the end of the year, the county will send a property tax bill, and the insurance company will send the homeowner's insurance bill. Now, in this scenario, let's say that the total bill is $8,000, and you have been sending off monthly payments to your mortgage company. But what we're going to do is we're going to make one change, and that change is you're going to call the mortgage company up and tell them that you want to handle these payments moving forward. And let's say that it just so happens to be that you have saved up into a savings account $8,796, and you have been doing that over time by making $100 a month deposits every time you get paid into this account. So this particular account is being handled by a machine or a company that is paying you 5.75% growth on your money every single year. Now, to be fair, there isn't an account out there at any bank that would pay you 5.75% as of the date of this filming this video. As a matter of fact, today you might be lucky to get 3.5%, but for argument's sake, let's say that it is 5.75%. Now, what is also neat about this particular machine is that you can take a loan against this money. And what you'll do is you'll take an $8,000 loan, and the machine will charge you 6.75% interest to take out this loan. Now, what's unique about it is that the machine is loaning you their money. Meanwhile, your full $8,796 is still sitting in your account, compounding at 5.75% interest. So you take this $8,000 and you put it into your personal checking account, and from there, you make the payment to the county and the insurance company and pay off the tax and insurance bills. Now, what we will do is, in this case, for the next 12 months after this bill is paid, you will continue to make those escrow payments that you had been making to the mortgage company, but now you're making those payments back to yourself over the next 12 months. And every single time you make an escrow payment, you will make a loan repayment back to the machine. So after 12 months is up, you will have paid back $8,295.51 to the machine. Meanwhile, after 12 months is up, your money has grown by $1,774.91, which your account is now $10,571. So during this situation, you have actually made a spread. Okay, so you've recycled 6.75% interest and paid that to the machine. Meanwhile, your money that was untouched has grown by 5.75%. So you've made a 5.75% spread, which means that you have recaptured $1.21 for every dollar that you spent out of your pocket paying your property and insurance taxes. Now, a couple of things of note regarding this demonstration. Number one, your expenses have not gone up. You are continuing to make those escrow payments, but you're making them back to yourself instead of to the mortgage company. Secondly, your account has grown because of the fact that it isn't only compounding, but you're also continuing to make those $100 deposits that you had been doing anyhow every single month. So what is this machine that we're talking about? Now, before you shut the video off and say that this is not a good thing, I just want to make it clear, this is a specially designed whole life insurance policy that is specifically designed for infinite banking. Now, once again, before you shut the video off, let me explain a little further. What makes them unique? You see, most of the financial gurus that try to talk bad about whole life insurance are usually referring to your garden variety, buy it off the shelf whole life insurance company that you can buy at just about any insurance company out there. Well, as of today, it just so happens that there are over about 700 insurance companies in the United States that sell whole life insurance. But out of those 700 companies, there are only about 10 that design these policies that are specifically designed for high early cash value, and which is a very beneficial factor for using the infinite banking concept. Now, in another video, I'm going to demonstrate what the infinite banking concept is, and we'll get into further in how these whole life insurance policies work. But in this particular situation, what makes them unique is the fact that you already get your cash value up front within 30 days or whenever your check clears every time you make a premium deposit into the policy. And that includes in year number 1, which you can't get that in another standard whole life insurance policy. So the way these loans work and what makes them unique is that you can use your own personal savings account or a 401k or a Roth IRA or any other standard savings account to do this type of recycle when it comes to your property taxes and insurance. But where whole life stands out is the fact that when you take a loan, you are borrowing from the insurance company. You are not borrowing from your account. You can't get that in a savings account or in your 401k or anywhere else, because what happens is when you take a loan, you are physically depleting the account balance and it is no longer compounding uninterrupted. Well, with whole life insurance, it remains in your cash value compounding uninterrupted, which makes it the most efficient way to store your money and use it to your advantage. I hope this was helpful, and if you have any questions, please reach out to me. I will have other videos coming your way, but thank you for tuning in, and we'll see you soon.